World over, equity stock prices are estimated or predicted using fundamental analysis or technical analysis. These two modes of analysis employ vastly different techniques. We will look at each of them in some detail. First, fundamental analysis. Fundamental analysis involves analyzing a company's equity, stock, or any security for that matter by determining its intrinsic value. Intrinsic value of the company is determined by factors such as the company's financial performance to date, its ability to invest and grow, its expected future cash flows, trends in the industry to which the company belongs, the competitive scenario confronting the company, the macroeconomic outlook within which that company is operating, and intangibles such as brand equity, IPR and patents, human capital, etc. The company's financial performance to date can be analyzed quite easily using time-tested techniques such as ratio analysis. Also, based on the information provided by the top management of the company about its strategy, planned investments and growth, etc., the future cash flows of the company can be assessed and the intrinsic enterprise value of the company can be arrived at using discounted cash flows, or DCF for short, that you would have learned in your early lessons in finance. Thereafter, other relative valuation measures vis-a-vis the company's peers in the industry are analyzed to review and reaffirm the intrinsic enterprise value of the company. These relative valuation measures include price to earnings or P/E ratio, price to book value or P/B ratio, enterprise value to sales, EV upon sales, enterprise value to earnings before interest, tax, depreciation and amortization, or EV upon EBITDA for short, etc. For those of you not familiar with the terminology, book value BV is in effect the net worth of the company. That means equity plus retained earnings as appearing on the balance sheet of the company. Enterprise value of the company, on the other hand, is the market value of equity. That means number of shares or stocks multiplied by the market price per share plus the market value of debt. The above methodology is at the core of fundamental analysis and helps determine the intrinsic enterprise value of the company. Dividing the intrinsic enterprise value by the number of stocks issued by the company will give the intrinsic value per equity stock. How is this analysis used for taking investment decisions? Here is how. If the prevailing market price of the equity stock is greater than the intrinsic value, then the equity stock of that company is considered to be overvalued and therefore said to be trading at a premium. Hence, unless there are definite reasons that can be attributed to the premium commanded by that equity stock, it would be appropriate to sell that stock. On the other hand, if the market price of the stock is less than the intrinsic value, then the stock is undervalued and said to be trading at a discount. Hence, unless there are definite reasons that can be attributed to the discount on the market price, it would be appropriate to buy that stock. The major assumption underlying fundamental analysis is that you can profit by purchasing undervalued stock, that is, where the market price is lower than the intrinsic value, because in the long run stock prices correct themselves to very nearly the intrinsic value of the stock. Fundamental analysis is more commonly used by long-term investors since their investment strategy is to identify assets that will increase in value over a long time frame.